So today let's do an update about the market. Let's talk about what's going on, because at the moment stocks are rallying massive, as well as the S&P 500. So what is kind of causing this rally in the markets at the moment? So let's just backtrack a little bit. Let's talk about Meta first of all. I just want to give these guys a shout out. Meta stock, I cannot believe, look at the last 5 days. Meta is up 7.8%. Let's just call it 8%. 8% in the last 5 days. Look at the year to date on Meta. 118%. You'd think to get these sort of returns, we'd be talking about a very small growth stock that's just done very well. We're talking about a 700 billion market cap company that is up 118% year to date. And you look at the really big lows, really, of them $80 in November time, and the stock that's up 207% since that time frame. It's not even a year. It's under a year we've seen a stock like Meta rally this much in this time frame. And it's crazy to think that only under a year ago, we were talking about stocks that were trading like, Meta was down at 12 times earnings. And within under a year, the market then goes, you know what, instead of trading Meta at 12 times earnings, let's trade it at 34 times earnings. It shows you how quick momentum can change the stock market. It shows you how quick a stock can be the dog of the stock market, the stock that nobody wants. Oh, it's a terrible stock, it's going bankrupt. And then you're talking about a stock once again putting in new 52-week highs this week, up in this week alone, up 8%. It's absolutely crazy what the stock market can do, and I just really wanted to point that one out. But going back to today's video, let's just talk about what's going on with the stock market. Let's talk about the rally at the moment. Now, in my opinion, the rally at the moment has been quite false. It's been hiding a few cracks in the stock market. If you look at last month, the S&P is up 4%. Now, in that time frame, I wouldn't say that most stocks, and I definitely wouldn't say my account personally, feels like it's up 4% in last month. However, in the last kind of 5 days, we see the S&P up 3%. I've got to say though, it feels like in the last 3 days, my account is up 3%. Now, the big difference is that for the whole month, the stock market really has been only lifted by AI stocks at the moment. Stocks that have been building up on AI, for example, would be Nvidia. You look at Nvidia in the last 1 month, you can see here this is up 41%. So when these stocks have a heavy weighting on the S&P 500, and Nvidia is worth, I can't remember what exactly it is, it's something like 6-7% of the S&P 500. When you got a stock like Nvidia going up that much, it's going to lift the S&P 500 because of the weighting it does have. But the difference is something like Nvidia today, Nvidia is actually down 1.2% today. And you look at the S&P 500, the S&P is actually up 1.5% today. So there's nearly a 3% gap between the S&P and Nvidia. So whereas this month has been driven up a lot by the AI hype, in the last kind of couple of days, that's broken. The whole market's been lifting up in the last few days. And I've got to say in particular, have you noticed the trend? And it's been happening in the last few weeks where Monday and Tuesday is quite weak, and then Wednesday, Thursday, Friday gets stronger and stronger. It's been a pattern of the last few weeks, and particularly this week, that back in the week you've seen the whole market joining, which hasn't been happening. So why has it got to the point where the whole market started joining in? And this was quite clear. I was doing a exclusive content on Patreon, which was a UK portfolio review, and if you do want to join, that link's in the description. You get 2 exclusive videos a week on there, and I had a few stocks planned to be buying right now, but because the whole market's lifted up, I've seen a lot of them stocks go up like 5-10% in the last few days. I'm like, oh, I was going to buy them at the moment, and now they've all lifted up. What's kind of caused that lift up in these share prices? Well, I think it's this. I'm going to try pinpoint what I think this is. And obviously this is just day-to-day movements, and as a long-term investor, you don't really want to be focusing on the day-to-day movements, but I think it's interesting to look at it and what it could potentially mean in the longer term. So I'm going to take you back to a few months ago. And actually before I do that, I just want to point this out. This is probably also another positive, is that the jobs report came in, and the jobs report was actually better than what was expected. And that's obviously one thing that a few people were looking at the interest rates going up at the moment and going, oh, if these interest rates keep going up, eventually that's going to have some impact on the economy. Now, looking at the jobs report, I've always said this, you can go back on all my videos for last year. As long as people are still in jobs, we will not have a recession. jobs report comes in once again strong, like it has been doing previously, and the recession hasn't happened. The interest rates that have gone sky high, the interest rates that a lot of people thought if it gets to these sort of levels we will have a recession, still hasn't happened. And I will stand by, we won't get a recession until the jobs slow down. And that's probably one thing that's causing actually a really good pop up today is the actual jobs report. But going back to the start of the year, I said that I think the S&P will actually return around about 15 to 20%. Now, if we actually look at the S&P so far this year, it's up 12%, so it's very close to what I predicted at the start of the year, but there's still a year to go and a lot can happen in a year's time, so I won't start showing off too much at the moment. But what gave me the confidence is history. Some people like looking at squiggly lines on the chart and go, oh look, it's gone this squiggly line here, so it's going to go on to new time highs. Oh look, this squiggly line here, or it's a weakness, it's going down. I'm not really too big fan of TA. I actually like looking at history. I like looking at history and go, when these events happen, what historically is the return? That's what gives me more confidence, is them history points. And 12 months ago, I was looking at going, well, let's look at inflation. Inflation is probably one of the main causes of why the stock market has been poor. 12 months ago, this was one of the main reasons why the stock market started nosediving. So if we take away this here, what do stocks do? When inflation peaks, when this main pressure that's on the market goes away from investors, what then happens in the market? Now, as most of you guys know, as I was sharing on videos back then, and you can check back on November time as well, I was sharing the same article. When inflation peaks, the S&P returns 13% average return in a year after inflation peaks. So let's look at when inflation peaked. Inflation peaked this month a year ago. Let's look at what the S&P is up at the moment. The S&P is up 12% year to date. Unbelievable how correct that is. You look at history, history says from this point, from a year ago, the S&P will be up 13%, and you look right now and we're up 12%. This is 1% off historic data. Unbelievable. And this is why I love looking at history of the stock market. We are 1% off the historic average of what the normal return is when inflation peaks. And that's one of the reasons why I had confidence on the market being positive this year, because of that issue. Now let's look at the next issue. What's the big issue that everyone's looking at? The next issue that's caused a lot of pressure on the market. It's probably the reason why markets haven't hit all-time highs yet. If this issue was to go, I think we'll see the market start pushing up to all-time highs. Well, the next issue is interest rates. Interest rates are what everyone is worried about. Now, interest rates, and this is one of the big misconceptions I'm seeing out there, is that people think the stock market can't do well at high interest rates. It can do. We've just had a very historic low interest rates. And it's historically proven as well that the market can do very well at high interest rates, and the economy can do quite well. The big difference is that everyone needs to know what the interest rates are. If you have interest rates and everyone knows what they are, companies can then, and the housing market, can plan on them interest rates. The problem you have is when interest rates keep going up and up and up, that's what causes uncertainty. But when you know what the interest rate's going to be, the housing market, growth stocks in particular, when they know what the interest rates are, they can still do very well there. And that's the big thing. Everyone's waiting for this, the interest rates to know what it's going to be in the longer term. And everyone's been looking at the Fed and going, when are the Fed going to pause? And this is why I think we've seen the whole market pull up in the last few days, and why it hasn't done previously. The last few days, the last month has been lifted by the AI situation. But the last couple of days, the whole market's been lifted up because of this reason. And this is, the futures have now rotated and now expect the Fed to pause in June. This is a massive turnaround from where we were only like a week ago. So if you look right here, the main cause was from a Fed governor that actually spoke, and that was one of the major points. You'll see here, following the comment that they made, the funds futures have now factored in a 70% chance the Fed will keep rates unchanged. The pause is going to happen, and now the market is expecting that to happen, and that's up from 30% a week ago. So we've gone from a 30% chance of a pause to now 70%. So the market is now factoring the Fed are going to pause, and that's probably why we're seeing the whole market drag up. Now, going back to history, going back to what I was saying earlier, why is this key when you look at history? Well, let's look at what happens when this situation normally happens previously. So the history shows that the federal funds rate has peaked 11 times since 1970. Now, the average return in the S&P 400 since that time frame, the S&P 500, not 400. There is a 400, but not the one that I was wanting to speak about. I'm speaking about the S&P 500. So when a pause happens, the S&P 500 and the Fed funds peak, the return is 14.8%. So that is very, very impressive. That's more than what we've had off the inflation. Now, if you look at the S&P 500, a 14% hike will obviously, from here, will take us to new all-time highs. So the historic data here says that if the Fed pauses, this is very, as long as it doesn't go back to increasing, that's key, but as long as it doesn't increase anymore from here, the stock market will return 14% on when we look at history. And also that will put us to new all-time highs. And I've got to say, if the Fed do pause in June, I was a bit worried they left it a little bit too late, but potentially we could get away with it looking at these job reports. And if we do see a pause and they continue to pause for the next 12 months, I could actually see us returning double digits from here, and we could see new all-time highs in the market next year. That would not surprise me too much. And that's what the market's factoring in at the moment. The market is factored in from, we're going to have another Fed hike, to, oh, you know what, actually, we might not have a Fed hike. And when we look at history, we want to get in early. You know, it doesn't matter about, a few people talk about earnings. It doesn't actually always matter about earnings. You know, the market will already start pricing that in. You'll see stocks recover at all-time highs before the earnings do, because people are trying to work out where the market's going in the future. This is obviously really good, and this is probably why the market's getting a little bit excited. Now, the one issue that we do have, this is what people are expecting. That doesn't mean it's going to happen. You wait, if we get into June when the Fed meeting happens, and if the Fed do increase by 25 basis points, you watch what the market does. The market will give everything it's pricing in back, and maybe even more, as it gets knocked back once again. And that's the big risk. So it's getting excited at the moment, but it could quite easily get knocked away. But it looks like that's what everyone's kind of, pricing in. So I don't really want to talk about too much about if the Fed's going to go up another 25 basis points, what's going to happen in the next kind of month. But this is why it's key as a long-term investor, because 12 months isn't a long time as an investor, but definitely as an investor, you would have seen already missing out on the 13% or, as we have at the moment, the 12% we've had this year. You would have already seen, if you miss that 12%, how much that can affect your returns. You talk about then if you do miss out on, if we do have another 14% rally in the next 12 months, and you miss out on that, once again, that's going to really hurt you. That's why you don't want to be missing out on that rally. And that's what's really key at the moment anyway. So yeah, just wanted to share that with you guys. Obviously a few things that are a bit short term and won't really affect you too much as a long term investor. But these are a few things that you want to keep in mind as a long term investor as well, I think. And maybe a little bit of a sum up with what's kind of going on in the market overall anyway. So I hope there was some useful information there as always, guys. If you could, smash the like button. If you're new around here, subscribe. If we do get to, we're on the brink of 14,000 subscribers. So if we can get to 14,000 subscribers, I will try to do a special live Q&A session at some point whenever that does happen. But hope you enjoyed it. For you guys on the Patreon, I will get another exclusive video up for you guys over the weekend, and I'll catch you on in a bit.